Have you ever felt lost, trying to make sense of the charts in front of you? You're not alone. Price action trading can be challenging due to the varying interpretations of charts. However, traders have developed indicators to address this issue and identify high-probability setups based on trends, support and resistance, supply and demand, and candlestick patterns. In this article, we'll show you how to use indicators for forex trading and a 3-step process to improve your trading performance. But before that, I want to introduce you to our backtesting service, as it makes it very easy and saves you time when backtesting your strategy. Thousands of traders are using Trader Edge to get an edge on their competition. It also has a lot of features that would definitely take you one step ahead of your trading career, just like the position calculator that serves as a great tool for risk management. Are you not sure how to backtest? No worries, you will also get a full step-by-step backtesting plan which has a $100 value. Not sure how to build a profitable trading strategy? No worries, you will also get a full course on how to build a profitable mechanical trading strategy, which has a $270 value. And if you sign up right now, they'll even throw in for pre-made high-quality strategies that have a $100 value. That's for $170 worth of bonuses, all for free. But only if you sign up right now. Trader Edge has a 7-day free trial, so there's absolutely no risk. Click the link in the description below. To begin with, for those who are new to the concept, let's discuss the fundamentals of price action trading. Simply put, price action trading involves making trade decisions based on the information presented on the charts without the use of indicators. However, a challenge that arises is the varying interpretations of the charts. Some traders may identify a ranging market and plot lines, while others may see a ranging market with a bullish or bearish channel. While either interpretation may be correct, the issue lies in the inability to backtest and derive reliable results from this approach. To address this, traders have developed modifications of scripts, known as indicators, that aid in price action trading. These indicators are used to rely on backtested results and identify high-probability setups in the market based on trends, support and resistance, supply and demand, and candlestick patterns. A combination of these indicators is employed to identify high-likelihood opportunities on specific instruments. In this context, we shall discuss how indicators can be used for forex trading and how a 3-step process can be applied to identify current price action in the market. Following this process can significantly improve one's trading performance, in contrast to traders who enter trades without proper and valid information. Moving on to step 1. When planning a price action trade, the trader must identify the trend and structural levels that require attention for a given market. However, during low volume and ranging markets, it can be challenging to identify these levels with certainty. To better work on this, I will have to add the harmonic pattern-based trend follower by he who must not be named. Quickly go to the settings, change entry percentage to 75 and stop percentage to 2. Then make sure the option for using close price is checked. Now on the style, I will be unchecking the bar color option, trend option, and also lines option, and we are done with the settings. Now, remember earlier, I said we would be taking trades when we get to identify low-volume ranging markets. To identify that, we simply wait until we see the price inside this box created by our indicator. Now, I know a lot of you would think that we just open trade when a breakout occurs. But that's not the case. We would have to apply our second step as we prepare our prediction for trade entry. To do that, we don't just guess if the price would go up or down. We add the order block finder, which is right here by Low. The purpose of this experimental indicator is to help in identifying institutional order blocks. Often, these order blocks can be observed at the beginning of a strong move, but there is a significant probability at these price levels will be revisited at a later point in time again. Therefore, these are interesting levels that predict where orders could push price up using the bullish order block and price down using the bearish order block. So, I guess you now understand what happens next, and the final piece of this process is to take action and enter trades. How do we successfully enter trades? For a valid sell signal, we first identify the last traded area of price action before its entry inside the box, and as we can see, it was above the green trend follower line. This shows that there are more bullish traders in the market. Then secondly, we would want to see the bullish order block inside this box or any part of the bullish order block inside this box. It could be the middle line and lower line or just the lower line only. Please, if you are enjoying our videos, don't forget to smash the like button and subscribe to the channel, as it motivates us on the hunt for the Holy Grail. Moving on. Then finally, we would want to see the price cross and close below the lower line of the bullish order block, while the bullish block or any part of it remains inside this box. If this setup happens, it simply means that 1. All bullish momentum is low, as the price has crossed and closed below our major support. 2. Not only that, if the price could break below institutional bullish order block after the price has been bullish, it means that there are no more buyers in the market. When this occurs, we hunt to open a sell position at the close of the trigger candlestick. Please note that it's advised to trade only once per order block position inside the box. As expected, it was successful. Like all other strategies, the major flaw in this trading strategy is fundamental analysis. News releases can trigger high-volume trades to knock out our stop loss or even go against us. But overall, this trading strategy is so powerful that you just need patience for the build-up. Once you get it, aim to enter for a profitable trade. Here is a buy signal we would have taken. We see all conditions have been met, as the price is inside the trend follower box. Again, we noted that the last entry point into this box was from below. As price breaks its major resistance, this indicates we only work with the bearish order block. As well, we have our bearish order block inside the box with price action closing above the highs of the bearish order block. We therefore open trade at the close of the trigger candlestick, with stop loss at the recent swing low. To add profit levels, we use 1.5 times the risk. We see it was successful. Let's now quickly go over the backtesting for this strategy to prove how profitable it is. We will be using an account size of 1,000, as we risk 1% of our account size on each trade. We have recently completed the backtesting process for the strategy under consideration, and the results indicate a favorable outcome. Out of a total of 200 trades, the strategy has yielded a win rate of 57.5%, comprising 115 successful trades and 85 unsuccessful trades, resulting in an impressive return on investment of 87.5%. It is important to note that the two significant spikes in the performance of the strategy resulted in a consecutive win streak of 8 trades, which also occurred here at about 5 winning streaks. Excluding these exceptional events, the graph suggests that the strategy would have generated a reasonable profit to be termed successful. However, it is advised not to make impulsive decisions based on this outcome alone. Thank you for watching, and see you in the next one.